All right, folks, this is a big week. We've got April 12th coming up, which is a CPI week. That's potentially more important than jobs data week, which is wild to say, but potentially is more important than jobs data week. In addition to that, we're going to talk about how the Federal Reserve likes to make decisions, how they kind of messed up potentially last time. We'll talk about Nick T's latest argument on the Federal Reserve. We'll also talk about the economists' take on what's happening with the stock market. So a lot of things. Again, catalyst, then Fed. Then we'll talk about the stock market and potential movements coming up this week. So the first and by far biggest catalyst this week is going to be CPI. But not only are we going to get the consumer prices, we're going to get some earnings reports. And a few of them will actually help us. Actually, really just one of them will help us potentially right before CPI. And in my opinion, that's CarMax. CarMax reports at 6:50 a.m., scheduled to at least, on the 11th. That's in 2 days. That's Tuesday morning. So we're going to be getting a CarMax report. And the estimate, they're looking for about 22 cents. But why CarMax? Well, one of the reasons I like CarMax is because obviously they're a used car dealer. And one of the things that we're seeing is we're seeing used car wholesale prices rise. But used car prices aren't necessarily coming up with how much those wholesale prices are rising. So what that means is if input costs are up, but consumer prices are staying limited, margin is getting squeezed, right? So we would expect, if we think inflation is going to come in softer, we would expect that potentially CarMax wouldn't be seeing that much of an average price increase per vehicle, and their margin, there is sort of the difference between what they're paying and what they're able to sell cars for, might show some shrinking pressure. Now, whether or not the stock moves up or down has everything to do with the expectations that analysts have set for CarMax, which is really beyond the scope of this video. But more importantly, I think we can look at CarMax as sort of a little CPI preview, because used and new cars make up somewhere between 5 to 6% of CPI and PCE, depending on which one you're looking at. Obviously, this week we're going to be looking at CPI. That's sort of the most popular one. And in my opinion, we're going to want to pay really close attention to CarMax as a leading indicator in terms of what we're going to be seeing on in that car or on that car side. So that could be a little bit of a trading heads up for us. So I'd definitely be paying attention to CarMax. Again, that is on the 11th. Then on the 12th, we'll get CPI, followed by more consumer data, unfortunately, after the CPI release. For example, on April 13th, we'll be getting Delta Airlines. We'll see, are airlines still able to raise prices? That's a big question. There's obviously a lot of demand for travel, hospitality, leisure, but the question is, can airlines continue to raise prices? We know there's still massive supply shortages in the aerospace sector, so the cost of doing business is rising. We also know that lower wage workers are earning more money, so a lot of the input costs for airlines are going up. But if they can't raise prices anymore, because as United and Southwest have mentioned, they're ready to embark on a price war if they need to. In other words, they are ready to lower prices to compete with their competitors if they need to, and their goal is to operate more efficiently. Well, we'll see. Are they able to raise prices? Are they able to operate much more efficiently? And how are those consumers doing with spending? So that'll be on the 13th. We'll get our first look at Delta Airlines. It's actually probably one of my favorites. Probably United holds a candle to them, but we'll see. Okay, then American Airlines is the most indebted, so something to keep in mind as well. Alaska, by the way, least indebted, I believe, out of all of the airlines. Anyway, then on Friday, on the 14th, we'll be getting JP Morgan, Citi, Wells Fargo, and BlackRock all in the AM. That is going to be a busy AM. That's all between about 5:55 a.m. and about 6:50 a.m. Eastern time. So the banking sector will be huge because we're actually going to get a glimpse at how much our credit standards actually tightening. Everybody keeps talking about how the banking crisis is going to lead credit standards to tighten. And maybe some credit standards have already been tightening over the last 6 months as we sort of walk into a recessionary environment. But Nat West was telling us last week that credit conditions aren't really tightening any more than the path they were already on during the credit crunch. Now, or during the last 6 months, I should say. Now, there are some indicators. We looked at these yesterday where we saw borrowing sort of fall during the couple weeks of the credit crisis or the banking crisis, and then a big spike right afterwards. And now people are wondering, okay, so is the credit crisis normalizing? Like, did we have a quick little pause and then a rebound? And is NatWest right that there really is no additional tightening? Or was that just people quickly withdrawing their credit lines down and potentially a credit crisis and a credit crunch is still ahead of us? Well, those banking catalysts will give us a massive amount of insight on Friday. But again, that comes after CPI. So the favorite data that we want to look for, CPI, obviously is going to be coming out on the 12th. Now, the 12th is a very big day because we have branded a complete coupon code around it. So make sure you check out those links down below for all the programs and perspectives on building your wealth, whether it's investing in real estate, whether it's investing in stocks, building your income as an entrepreneur, an employee. You want to learn about LLCs, liability. You want to learn about how to best own real estate, the best deals to get, how to build your wealth with real estate, how to actually go zero to millionaire. Everything, whether it's stocks, businesses, making YouTube videos, being an agent, there's a program for you. Check them out, linked down below. While I am a licensed financial advisor, those videos are non-personalized financial advice. They are a pathway that you could take very much inspiration from, which I'm very excited to share with everyone. So then CPI. So CPI also comes out on the 12th, which is the day of the expiration of the coupon code, and prices will be going up. So CPI expectations just changed. Now, this is actually interesting. I was not expecting CPI numbers to change in terms of the economist expectations going into the read. So on Wednesday, April 12th, we have the CPI expectation of, instead of 0.3%, which was the expectation the last time we looked at the data, that number has actually moved. And on the month over month headline, it has moved down to 0.2% month over month. Now, I was a little surprised by that we saw a shift down to 0.2%. That is going to be great on a headline basis. We'll be shifting down from 0.4 month over month to 0.2. 0.2 annualized works out to about 2.4%. Which is fantastic, absolutely great. So I'm very happy that the survey is sitting at a median estimate of zero point 0.2. There are 58 qualified estimates in from the Bloomberg analysis, or rather 58 qualified economists putting together 38 estimates, I should say. So some of them bundle up. You've got UBS, TD Securities, and Wells Fargo, actually just UBS and TD coming in at 0.1%. Most of these coming in at 0.2%. Oh, if I actually sort them, there are a few more at 0.1. There we go. Okay, it looks like there are 1, 2, 3, 4, 5 estimating 0.1%. And then there are only 4 estimating 0.4%. Most of them sit around 0.2 or 0.3%. And the average estimate is 0.24 if you really want to get to the nitty gritty. Sometimes in the course member live streams, people ask me, they're like, oh, can you give me the exact number? So I'm like, yes. CPI, that's month over month. CPI core month over month is expected to be a little bit hotter. Core, that's going to remove the energy slump and energy price slump that we've seen. And when you remove that out, you're actually looking at a survey of 0.4, which is 4.8% annualized. Keep in mind, after we saw a oil production cut by OPEC plus members, we have seen oil prices rise. But what's actually quite surprising is how little oil prices have really risen relative to what you would expect. Look at the chart on screen here, which is branded with our beautiful overlay for the coupon code. There we go. Take a look at this. These are this is the international blend of oil. It is Brent crude. That's to be not to be confused with WTI, which is the Western blend. And when you look at the 6-month chart here, obviously you could see that during the banking crisis, we had a big slump for oil demand. But what we've seen is oil prices rise after the OPEC plus production cuts. But folks, look at this. We can't even break resistance that we had before the banking crisis, in mid-Feb, in late January, in late December, in early December. We are not breaking out of that channel. So OPEC Plus is probably punching the air right now, wondering, why can't we break out? Well, potentially part of the reason is futures markets are pricing in recessionary fears in the oil market. And obviously, if we trend towards a recession, the expectation is that we would have a fewer, or should I say, less oil demand. That would be the expectation. So continuing with CPI here, CPI year over year has also just been reduced. CPI year over year in the prior read was 6%. Folks, buckle up. And maybe get your life insurance within as little as 5 minutes by going to betkevin.com/life, where you can Apple Pay and Android Pay for it. CPI year over year has just been revised to 5.1%. The high estimate is 5.4, the low is 5.1. The median estimate is 5.1. So you have a really big skew to the left side here, which means you have a high bar chart on the left and then very, very few estimates on the right side. So people really convinced that this is going to come in at 5.1. Remember, the prior read here for headline was 6%. We're going to see almost a 1 percentage point or an entire 1%, 100 basis point plummet in inflation, almost 90 basis points. That's incredible. And a lot of that, again, because of energy prices. Because when you look at the core, you're actually expecting to see core tick up slightly year over year. You're going to move from a prior expectation or a prior read of 5.5 to about 5.6. So, what is that going to signal? Well, it's going to mean we're going to have to look at the granular data. How are those core services doing? And those core services are going to be what we're really going to pay attention to. Now, we want to talk about what the Federal Reserve and Nick T are up to as well, and how this could affect the stock market. But before we do that, I quickly just want to look at and read off some of the core services we're really going to be paying attention to. And I think they'll be critical. And remember, the catalysts from CarMax, from Delta, and from the banks in terms of what, and even what they say in the earnings call, are really going to help shape an understanding around this CPI report. So I really think that's going to be important and a basis for what the Federal Reserve is expected to talk about in May. Now, remember, the May Fed meeting is going to be based off this CPI report. That's really important because the next May meeting occurs on May 2nd and 3rd. Too early to get another CPI report. So whether we get that 25 BP hike or not is going to be dependent on these catalysts, likely this week. Keep in mind that right now, the futures market is pricing in a 65.5% chance of a 25 basis point hike in May. We are also pricing in a 64.7% chance of a pause in June. Now, we're going to be looking specifically when it comes to CPI, and obviously, category number one, are we continuing to see goods disinflation? Very important. Number two, have we started to see any rent deflation yet? That is rent of shelter, lodging away from home, hotels, rent of your primary residence via owner's equivalent rents. Last read was 0.7%. That's 8.4% annualized. It's a high. We want to see that come down. But the other thing that we'd like to see down are obviously airfares, transportation services. We'd also like to see other services like haircuts, phone services, legal services, postage services, education services, photography services, pet services. We'd like to see all of these normalize. Now, pet is one of the largest sectors that still seems to have lingering pricing power, or that is the lingering ability to raise prices in the face of higher costs. Pets and pet supplies are really still passing on those prices. So that could come up in CPI as well. Now, we expect that to wane as household formations for pets are flat, at least according to Petco's earnings call. Household formations are flat at the start of the year for more people basically having pets. And that could be an indication that that pricing power may wane for pet stores. But so far, if you're looking at companies like Chewy, it does look like these companies still have pricing power. The question now is, how long will that stay and last? Now the question is, what does this mean potentially for the stock market and the Federal Reserve? Well, Nick T put together a pretty detailed report on how much panic there was at the Federal Reserve during the banking crisis. Usually, the Federal Reserve decides how much to raise interest rates weeks before the actual Fed meeting. However, in this last crisis, the Federal Reserve decided just 2 days before the March 22nd Fed FOMC meeting whether or not to raise rates, which they did by 25 basis points. And the reason they waited so long is they waited for Swiss authorities to help solve the Credit Suisse disaster. Now, if anybody's ever watched the Bourne series, which is my favorite series ever, I just watched the first half of it with Jack, my 7-year-old, yesterday. We got to the car chase in Paris. But anyway, think about how exclusive Swiss banks are and how important Swiss banks are to the banking system. The reason I bring up Bourne Identity is because, of course, Jason Bourne has to collect his resources from a Swiss bank in Zurich. And so this banking crisis was a huge blow to the Swiss banking system. But the Fed actually heavily leaned on what was going to happen with the UBS bailout, basically buyout, along with the government bailout, the Swiss National Bank basically guaranteeing the next $9 billion. And actually, I think UBS was willing to take up to $9 billion of losses, and the Swiss National Bank was willing to take the next 15 billion in losses to orchestrate that deal because there's not enough time to underwrite the entire book of business for Credit Suisse. Anyway, long and short of it, the Fed was looking at that deal to decide whether to pause. And they were seriously considering pausing because of the banking crisis in March. Now, that was a risk because even Bullard, who generally suggests we need to get to a higher rate as soon as possible, suggested that if we paused, we would have potentially signaled fear. And usually, the formal statement for the Federal Reserve is actually drafted up to a week before. That is, the decision could be made as much as 2 weeks before. The statement is drafted a week before. But Powell didn't want to rewrite the statement, so waited until literally the last minute to decide to go with a 25 basis point hike. The Economist had a great piece yesterday talking about how the banking turmoil has potentially been ignored by the stock market. And I think the stock market cares actually more about what we're going to get in numbers this week. And I want to talk to you about good news is bad news versus bad news is bad news, because The Economist talks about it as well. The Economist cites that investors have dumped stocks when banks have failed before. They go into history and say, look, go back to Continental Illinois. That was a bank that failed in 1984. The Fed had to rescue it, and the Dow dropped 6.5% because a bank in Illinois failed. Stocks slid 10% when Lehman Brothers crashed in 2008. It's obviously substantially more after that. And in September of 2029, between September of 1929 and July 1932 during the Great Depression, banking failures led stocks to fall 89%. So a banking crisis is a massive deal when it comes to the stock market, especially now with deposits fleeing to money market funds. But what's actually remarkable is our stock market's kind of like, whatever. What did our stock market do? The S&P 500 returned 4% during the banking crisis. European stocks were up 3% during the banking crisis. The NASDAQ was up 7% during the banking crisis, led by companies like Microsoft and Apple. Retail trading flows have been elevated since 2021. And even though retail plowed money into the market, about $17 billion in the first 2 weeks of February, they actually plowed the lowest amount of money into the market during the 2 weeks of the banking crisis, the lowest amount since late 2020, just $9 billion of retail inflows during the banking crisis. So retail was actually nervous about the banking crisis. The stock market actually went up during the banking crisis, suggesting that some institutional investors actually saw the banking crisis as an opportunity to finally buy in. Now, that's interesting because, after all, just 20 stocks have led 90% of the S&P 500 surge year to date. Meta, Apple, Nvidia, Tesla, and the likes. They have led the vast majority of the surge of the S&P. And this is something that I've been talking about as well, is that this is the kind of market where you don't want to be exposed to all of the staples that are going to get sandbagged in an earnings recession. You want to be exposed to PP, pricing power stocks. That's what you want. I encourage you to look up pricing power stocks. I teach about pricing power stocks. Just go to meetkevin.com. You can learn about not only my courses on building your wealth, my affiliate links, my actively managed ETF. All of the information is at meetkevin.com. So just go there and learn more. But anyway, the question now are people being blind to a potential recession? I mean, if historically stocks go down in a banking crisis, why in this banking crisis did they not go down? Now, that is a question that I'd like to answer right after I just shout out Crypto Lifer, who just donated $50, saying that today is their 40th birthday, sending you some love. That's awesome, Crypto Life. Or hey, man, send us an email, kevin@mekevin.com. Good for you, man. All right. So now, and by the way, thank you to all those of you who emailed me yesterday about the gold backed digital currency. Expect some email replies today. Okay. So now we've got to ask ourselves, is bad news good news? Right? Initially, when we went into the cycle, we wanted to see weak data, weak manufacturing data, weak services data, because it would suggest that inflation is no longer a problem. Well, this inflation report may tell us as a catalyst that inflation is no longer a problem. The real problem is actually recession. And how deep is the recession going to go? Are we going to go negative GDP by Q3, Q4? Or is this all going to be a funny joke and everybody's going to be comparing or waiting for a recession and the recession's never going to come? We don't know. We have no idea. But the CPI report will be a big catalyst, I believe, to letting us know, A, is inflation going to prove to be transitory or not? If we end up having any kind of here are risk factors: a reacceleration in demand inflation and a reacceleration in services or housing inflation would be absolutely devastating. Now, look, for example, at expectations related to CPI going forward. Now, this is a phenomenal. Well, actually, these are not CPI directly inflation expectations, but I want to show you this. This is from the Federal Reserve, the St. Louis Bank and the Federal Reserve, and it's phenomenal. I suppose before I show you this, let me just quickly finish the thought. So, generally, bad news has been deemed good news, but if inflation proves to be transitory, is it possible that bad news is actually good news? Or is it possible that bad news is actually just straight up bad news? And the answer is yes. Bad news could be straight up bad news. Why could bad news be bad news? Because if inflation goes away and then we've proven to have over tightened, well, then we got big problems. Because if we've proven to have over tightened, now we've got oopsie doopsies, because now we go into a deep recession potentially. Now, again, I have aligned the expiration of the coupon code with CPI Wednesday, so the 12th. So make sure you get in. Remember, you could use buy now, pay later, and you get a price guarantee for going forward for life. The price is guaranteed, will never be lower, or you get a price adjustment, which is a phenomenal opportunity for you. No excuse not to join. And you get all those custom course member live streams, as well as all the lectures and perspectives on building your wealth and the research that I do. I mean, everything. You learn everything. You can ask me any question you want. So take a look at this. This is an 8th district businesses report, which basically they survey 8 different districts, and they do a report about persistent inflationary pressures here. And listen to this. They surveyed CFOs in a CFO survey, and then they looked at BLS statistics for consumer prices and producer prices. They looked at forecasts and what actually happened. And what I want you to see is who was basically most wrong. So in your CFO survey in 2022, CFOs thought prices would rise 4.2%. They actually rose 8.4% in the eyes of CFOs and companies that were interviewed. That's different because it's not a survey of all prices, which you get, via the CPI or PPI baskets. So that's why there's a difference here. But the point is, CFOs were wrong about inflation by a factor of 2. Look at this. They were expecting inflation prices to go up 4.2%. Prices actually went up an additional 4.6% at 8.6. That shows you that CFOs were caught flat-footed in the face of inflation. They were not expecting this much inflation. From a consumer price point of view, via the Bureau of Labor Statistics, we were expecting 4.4%. We actually got 6.4 in consumer prices. PPI, we were expecting 5.9. We got 8.7. Now, what I like to look at, though, is the forecast for 2023. And you could see this softening. In 2023, you actually see forecasts of just 4.8% for the total survey. CFOs are now catching up. CFOs actually think inflation might actually be more persistent. But consumer and producer prices actually suggest that inflation will be lower. So CFOs have historically been wrong. They've been very wrong by a factor of 2 over here. Now CFOs are projecting higher inflation in 2023. But is it possible that they're wrong again, and this time they're overestimating inflation? Entirely possible. So I believe, to sort of sum this catalyst segment up, I believe the big thing that we want to pay attention to here is a combination of everything that happens this week. I don't think we can narrow this down to one catalyst this week. I think this week you want to write down on a Post-it note or something, you want to write down A, CPI the 12th with the coupon code expiring, prices going up. Then you want to look at CarMax on the 11th, the day before. Sorry, that's slightly out of order. Then you want to make sure you pay attention to Delta earnings and what happens with the banks at the end of the week. Because think about it, all of that together is going to give you a view of, is the CPI CPI? CPI is CPI. If CarMax is raising prices a lot and the airlines are raising prices and credit is fully available, right? Now, do keep in mind, and I didn't talk about this one. This one's a little bit less, popular, but we are also the very next day on Thursday going to get PPI, producer price, really quickly. I'll go into this one quickly. It's less popular, but the very next day, 5:30 a.m., we'll get PPI month over month expected to be 0. The month over month core is expected to be 0.3, as well as month over month core X trade 0.3. But year over year is expected to plummet. We could see year over year headline PPI go from 4.6% to 3. And PPI core go from 4.4 to 3.5. And then X trade as well, 4.4 to 4. So a big plummet there in PPI expected. So you've got a very busy week. And I think after this week, we'll be able to really nail down, all right, are we going to get 25 BPs or not? Remember, the expectation right now is that we're looking at a 65% chance of 25 BP in the on the May 2nd and 3rd meeting of the Federal Reserve. That's 65.5% to be exact, and 65.7% of a pause in June, with, of course, rate cuts being priced in still towards the end of the year. The only way we're really going to get rate cuts towards the end of the year, in my opinion, is actually if we end up having a blowout low report on these CPI and PPI numbers, which we may get. And then everything will turn from fighting inflation because inflation will then have proven to be transitory, to fighting a recession. Rates, by the way, are expected. This is a crazy chart. My gosh, this is a disaster. So rates are expected to pause in June. But if I look, the first cut is already being priced in for July with, oh my Lord, what? By January 31st, we're now pricing in almost 2.5% in rate cuts. That is an insane curve. Holy crap. Oh my Lord. Okay, let me show you this because it's actually almost slightly hard to believe how the shape of this curve. This is insane. Now, that is a little risky as well because if the market is pricing in this kind of curve and it ends up being wrong, well, that's going to be a little bit of an oopsie doopsie, eh? And we're going to have to do a little bit of price adjusting. And remember, that's how the market somewhat works too. Is the market can rise based on expectations of rate cuts. Maybe that's why we saw the stock market rise, because now we're thinking, okay, the Fed's certainly going to cut. But holy smokes, look at this particular chart that I'm going to show on screen right here. Look at those cuts. My goodness. Now, the way to read this is basically you look at right here is your peak, right here is your pause, here is your first cut. So this is about 5.25%, 5 to 5.25% right here would be the range. And then you get your first cut over here, another cut, many cuts. Look at this, huge cuts coming towards the end of the year, followed by some smaller cuts over here. I mean, the cut over here looks like a 1.5% basis point cut. I mean, let's draw that really quick. You're going from about -1.25 here to about -2.5. That's a 125 basis point cut that is being priced in for December, followed by, and that's just that bar difference right there. The cumulative would be somewhere around a 2.5 to almost 3% cut it'd be about like 2.2.5, 2.75, 2.5 to 2.75 base priced in by the end of January. That'd be around my birthday time. Oh my gosh. Wow. So if we don't get those cuts, I think the market might be a little sad. In fact, that's exactly what TD or TS Lombard mentioned. They said, if the Fed does not start cutting, we're going to have a big oopsie doopsie because the market's going to go, oh, damn it. The Fed is over tightening and they're not even realizing it. Holy hell. Please get your life insurance in as little as 5 minutes going to metkevin.com/life. Yes, you have the debt ceiling crisis looming as well, but that, my friend, is for another segment. Thank you very much for watching this segment. It was very detailed and hopefully very insightful.